So we all know people who, based on their lifestyle and health, aren't expected to live long, yet they live well beyond life expectancy. Regardless of how many factors you take into account, you're taking huge risks trying to estimate when someone's going to die. If you look at average population mortality tables and base it on life expectancy, half of all people will live beyond that. So a more prudent approach is actually to focus on maximum probable lifespan, which is a 1 in 10 chance that someone exceeds, not just achieves, life expectancy. Addressing the uncertainty of lifetimes is the most important challenge in retirement planning. A financial contract available in Australia that addresses uncertain lifetimes is lifetime income annuities. A life insurer can pool a huge range of lives and price a lifetime annuity based on average life expectancy, and yet continue to pay to the surviving annuitants beyond maximum probable life. For a 65-year-old person in decent health, to secure a lasting retirement income, it would likely cost a lot more had they not purchased a lifetime annuity than if they transferred that risk to a life insurer. Let's look at it this way. You've got to accumulate a lot more retirement savings to secure an income to your maximum probable lifetime than if you actually bought a lifetime annuity where a life insurer is pricing that to your life expectancy. A prudent 65-year-old needs to start thinking about planning for retirement to age 95 and a couple to age 98 and beyond. Planning for retirement has to last the distance. Annuities may seem complicated, but they're actually quite simple. Let me explain. There's 3 components that make up a lifetime annuity. There's the principal and interest component and the mortality credit component. The principal component is simply the return of the capital over the expected life of the annuitant. Let's take an example of a 65-year-old with a life expectancy of 20 years investing $100,000. The $5,000 is the return of capital, and that continues to be paid for that 20-year period. The interest credit component is simply the interest that the life insurance company makes on the invested capital. Now, the mortality credit component is the remaining income payments that would have been paid to annuitants that haven't survived, and that gets spread across the remaining annuitants. The mortality credits initially start at 0 and increase over time. So the longer you live, the more mortality credits you receive. So the benefit of lifetime annuities is that as the principal gets reduced over time, the mortality credits increase, so therefore the income you receive continues for as long as you're living. The major benefit of lifetime annuities is that they only expire when you do. A staggered annuitisation strategy is where separate annuities are purchased at various intervals that reflect your personal cost of living. Now, the genius of the strategy is that as interest rates rise and inflation rise, the supplemental annuities payout rate also increases. So let's assume you purchase your first annuity at a 3% interest rate, and subsequently interest rates increase to 4 or 5% and inflation goes up from 2% to 3%. There's 3 things that actually work in your favour. First, the cash reserve that you've set up, the interest earning on that will increase due to the higher interest rate. Secondly, the purchase of the supplemental annuities will be based on the new higher interest rate, because annuities are priced based on what the underlying interest rates are at the time. Now, thirdly, because you've deferred the purchase of the annuities to a later age, you're getting the benefit of a higher return on principal component as well as mortality credits. So those 3 elements together mean that the supplemental purchases of annuities is much higher, and the total income you can generate can be higher than if you initially purchased the annuities up front. You may ask what would happen if interest rates and inflation reduced. The increase from the supplemental purchase of annuities would be lower than would otherwise be the case. But also, your cost of living expenses wouldn't increase by the same amount. So you would expect that the 2 would closely match. So this strategy is not to maximise lifetime income, but to ensure that you've got the right level of income at the relevant ages. It also provides you with greater flexibility if you needed access to your capital. If you're considering a risk-averse approach to retirement, you should really make an assessment of the annuity provider. Fortunately, in Australia, we've got strict capital standards, which provides great certainty for investors. When you're looking for an annuity provider who can back up their promises, you need to look at beyond who's providing the highest rate or highest payout rate. You need to consider spreading or diversifying your risk between a range of strong annuity providers. CommInsure has been around for over 140 years in the Australian insurance industry and provides scale and tenure that can provide peace of mind to retirees. For more information on our Retire Smarter Thought Leadership series and the strength of our life company guarantees, visit comminsureadvisor.com.au/retirement or speak to your local retirement BDM.